All right, so today we're basically going to be tying together everything we've been talking about so far in this course and looking at how we will be using this information in practice to actually go about starting to value companies. All right, so that's what we're going to be dealing with valuation. We'll also be talking a little bit on the bank side of credit risk assessment, but that's going to be a much shorter discussion. All right, so when we value anything, there are three things that we need, especially when we're dealing with a terminal value. Anyone remember what those things are? You even got the order of it. Yeah. Cash flows are fundamentally the most important thing whenever we're looking at the value of an asset. It doesn't matter if we're talking about stocks, bonds, real estate, commodities, options, anything. What we are concerned about is fundamentally the cash flow that the asset is going to be generating or is expected to be valued at in the future. Cash flows are necessary for any asset to have value. Doesn't matter what else we're considering. It doesn't matter market factors, right? If we expect there to be a huge demand surge, if there are not cash flows tied to an asset, all we're dealing with then is a speculative bubble. And it's possible to make a lot of money off bubbles, right? But over the long run, it's not a sustainable approach to generating portfolio returns. Cash flows are necessary for any portfolio to be generating value over the long run. All right, so understanding an asset's cash flow leads to understanding the asset itself. And that is fundamentally the most important thing that we're dealing with, not only in this course, but the field more broadly, understanding cash flows. All right, the next thing, just to give you a little hint on what the next answer is, the timing of cash flows matter. All right, so we need those cash flows, but also the timing of it. So what's the other thing that we need to value an asset? Goes in the denominator, time value money problems, taking the present value. Yeah, discount rates. Right, so we have cash flows. We need cash flows in an asset for it to have any value. But the next step is understanding the timing of those cash flows, right? Because the timing of a cash flow is intrinsically related to the value of that cash flow. Right? And this is something I'm going to keep repeating throughout today and throughout the review. It's a necessary thing to understand. Cash flows are fundamentally necessary for an asset to have value, but in addition to that, the timing of those cash flows is relevant to the value of those cash flows as well. Right? Again, if we were to, right, would you like $1 million? If someone to hand you $1 million, would anyone not want that? It's easier to keep your hand down that way. Right? Who would say no to $1 million in the bank? What if it was given to you in 1,000 years? Does that affect your life in any way? No. Right? So the timing of cash matters. Even if we're dealing with the same nominal cash flow, when that cash flow occurs matters to the value of that cash flow. The way we adjust for that timing is through discount rates. Interesting thing about discount rates, we don't know in some asset classes what the appropriate discount rate is. When we're dealing with the bond market, when we're dealing with treasuries, we explicitly see the discount rates in the market because they are quoted at the time of issuance. Right? When the Fed goes to release another batch of T-bills, you know what the discount rate is because they're telling you what it is on issue. But when we're dealing with something like the equity market, we don't know what the appropriate discount rate is. It's basically educated guesses trying to figure out the appropriate discount rate to apply to stocks. So there's a lot of time and effort put into figuring out both the expected cash flows of an asset and the appropriate discount rates for that asset. Because those two things are some of the largest components. And the last bit, technically it's tied to the cash flows itself, but it's also the cash flow growth rate. All right, so the way I like to think about tying these things together is thinking about an asset in perpetuity. Right? If we think about an asset in perpetuity, it's the easiest way to put all this information and memorize it. Right? If you remember the growing perpetuity formula, that leads you to the answer on the most important factors. Right? When we're looking at the value of a perpetuity, it's the next period's cash flow. So the expected cash flow the asset's going to grow at. the discount rate that we're discounting those cash flows at, and the growth rate of those cash flows. Right? So if you can memorize the growing perpetuity formula, that will point you in the direction of answering what are the most important factors of an asset's value. Not all assets will be growing in perpetuity, but this is probably the easiest formula to memorize that'll point you in the correct direction. You need cash flows, you need a discount rate, you need to know the growth rate of those cash flows. Those are the three most important things, and they're all reflected in a growing perpetuity formula. Cash flows, discount rate, cash flow growth rate. All right, so more specifically, right, when we're trying to figure out the present value of an asset with a single cash flow, we would just use the present value formula. We spoke about this at the beginning of the class. We'll talk about it more today, do some examples. But when we're taking the present value, we have a future cash flow, right, the next time period's cash flow that is expected to be generated, discounted at the discount rate, raised to the number of time periods between the present and the future value, right? Usually number of years, right? And to simplify things, we're just going to keep everything in whole round years, but we can get a little bit more specific and use fractions of years depending on when we're looking at information. Specifically, when we're valuing a business, right, what's the appropriate discount rate that we're going to be using? The discount rate that we're going to use to value businesses are their weighted average cost of capital. Right? The weighted average cost of capital is a reflection of their cost of debt and equity. Now, companies do have other sources of external capital, but debt and equity make up the largest fraction of a company's external capital. They also typically are, relatively speaking, the easiest bits of information to get. So between debt and equity making up the largest fraction of a company's external capital and that being relatively easy bits of information to gather, typically debt and equity are what is going to be used for a company's cost of capital. So we're going to be looking at a company's cost of debt and cost of equity, weighting them by their proportions to a company's overall capital structure, and using that as the discount rate for a firm. All right. And in perpetuity, this is the formula that we're going to be using. Little asterisk here to note. When is it appropriate to grow expected cash flows in perpetuity? When you're dealing with equity, when you're dealing with valuing a company, typically we assume 3 to 5 years out. That's very often how financial models are constructed. 5 years is probably the most common. You'll sometimes see them going up to 10 years out. But once you reach that 3 to 5 years out, typically you assume the company is going to grow at its terminal rate from that point forward, and then you're going to be using the terminal value to estimate the firm's value. And very often when you're looking at a firm value, the terminal valuation of the company's cash flows make up the largest proportion of that company's value today. All right. Reminder on how we can calculate free cash flows. We went over 3 methods. The lazy method, which is just, what exactly was it? It was net income minus capital expenditures, I think it was. Yeah. Or no, operating cash flow minus capital expenditures. The next level would be the bottom-up approach. So net of tax operating performance plus depreciation and amortization, net capex, net change in working capital. And then the technically most accurate, the depreciation tax shield method of calculating cash flows. I think we spoke about these last class or the class before that. But I recommend going through that sheet if you don't remember. Right, this is one of the methods we can use to calculate it. Weighted average cost of capital. Right, this is the discount rate that we're using on those future cash flows of the firm. We take the weight of equity multiplied by the cost of equity, the weight of debt times the net of tax cost of debt. Right, why are we using the net of tax cost of debt? Interest is deducted from a company's income to reduce their taxable income. So for every dollar in interest that they pay, they're paying 1 minus their tax rate toward their cost of capital. All right, so we get all that information, put that together into our cash flow table to value the firm. But where exactly are we going to find all this information? When we're looking at cash flows, we can get it from the income statement, 2 years of the balance sheets, and or the cash flow statement. When we're looking at the cost of capital, cost of equity is going to have to be estimated. Sometimes you'll see it on a company's tear sheet in their 10K, what they use as their discount rate. Very often that will be held internally though. So typically we're going to have to estimate it. There are many methods for estimating a company's cost of equity. The capital asset pricing model is the most commonly used method, though it does have a lot of issues with it. And the company's cost of debt. We can use a company's 10K. They'll have tables showing how much their cost of debt typically is. So we can use that as an estimate. Or we can use the company's credit risk profile as an estimate. And there's another free resource that we'll look at that gives basically an industry estimate for the cost of debt. Oop. And then we have cash flow growth. All right, so this information can be, we could just use the historical average of the company's cash flow growth if it's growing stably. Other places we can look at management discussion. They might point towards what they expect the terminal growth of the company to look like. Analyst discussion around the company, or economic intuition. And we're going to talk a little bit about that on basically the boundaries on what a reasonable terminal growth rate is for most companies. Right? Because we're dealing with a field that is basically making decisions today based on future conditions, right? We don't know what the future has in store, but there are things that we can do today that we can have a sense for what will likely occur in the future. All right, so we're going to look at what a financial model can look like, and we're going to put together a simplified one. All right, so first we have to put together some of the relevant assumptions. We're going to need tax rate information, how much the company typically pays in taxes. One important thing to keep in mind is whether the company you're dealing with has had any significant tax changes, or if at the federal level, state level that they operate in, if there are significant tax changes, right? When the tax cut came out, I think that was 2017, that resulted in a significant change in the typical taxation of companies. So if you're looking at historical data, the expected tax rate that you would be applying to future cash flows was much higher than it actually should be. Right, 30% tax rate is on the high side, especially given the tax environment over the last few years. We did information on the risk-free rate for CAPM. Right, so a reminder on CAPM. I think there's room over here. All right, so CAPM is one of the methods we can use to estimate the expected return on equity. That's going to be the risk-free rate. So starting with the risk-free rate plus the amount of risk through beta times the expected market return minus the risk-free rate, or the market risk premium. Right, CAPM, and we'll see the formula in Excel in a little bit. All right, with CAPM, we're estimating the expected return on equity, starting with the risk-free rate. So that's basically our baseline level of return for a given asset. If there is no risk at all, the risk-free rate is the return that we should expect to receive. In practice, typically we assume that's the treasury rate. Right, so there's a lot of debate on should we use short-term treasuries, should we use the longer-term treasuries, go past T-bills into the 10, 20 years. So there's debate on what the appropriate risk-free rate is. I believe so. I took this from Capital IQ. I'm pretty sure they use the 1-year rate of return on T-bills for the risk-free rate, which are currently at 5.5%, or as of yesterday. Right. So the risk-free rate is the baseline level of return that is expected to earn. From there, we add the amount of risk in an asset measured through beta. So beta is a measure of amount of risk. It's basically relative to the overall market. If an asset is riskier than the market average, beta is going to be greater than 1. If it's less than the market average risk, going to be less than 1. Then we have the market risk premium, which is the compensation for bearing that risk, right? So the more assets are compensated for being risky, the higher your expected return on that asset is going to be, right? So 3 components here for CAPM: the risk-free rate, beta, market risk premium, and we'll look at different resources to get all that information together. All right. It's got information on the S&P 500 market return. So that's the expected return on market and the market risk premium we just wrote about. So that total market risk premium is going to be the 11.6% minus the 5.5%. That's going to get us the market risk premium. Then we have information on cost of debt down here, as well as preferred equity. Bless you. Most companies don't have preferred equity, so typically that's going to be 0. All right, so we put all that information together. We get our cost of equity using CAPM. We get the cost of debt, which this model uses the last 5 bonds issued as the company's cost of debt. They take a 5-year average tax rate. These are typically one of the places you're going to have to take careful consideration of, because that's higher than the effective tax rate, right? So something was going on with this company that it had a higher tax rate over this time period. That's an important thing to keep in mind when putting this info together. So finally, we get the total weighted average cost of capital by weighting the cost of debt plus the weighted cost of equity, and that gets us our weighted average cost of capital, right? So this is the discount rate that we would use and apply it to future cash flows of the company. Now things get a little bit more complicated, but all we're looking at here is a cash flow table, right? So they're calculating the unlevered free cash flow using the method we just saw in the PowerPoint. So they're starting with revenue, getting us to EBIT, netting out taxes, adding in depreciation, amortization, netting out capital, netting out changes in working capital. Right, that brings us to our free cash flow in each year. Then the model just averages out the average cash flow growth over the previous 5 years and uses that to project the future cash flow. Right, so there's a lot of information here, but really it's stuff that we've already looked at. We're just calculating cash flows. We're just looking at a larger table on what those cash flows are being applied to. Right, so typical model standard is we take the previous 5 years information, 2019 through 2023, forecast the next 5 years bits of information, and from there we're going to be taking our terminal value at the end of the 5th year. Right, which is what we're going to be doing in the last step here. Right, so we're taking the present value of those free cash flows, taking the present value of the terminal cash flows, adding that up for the company's total value, netting out debt, and then arriving at the total equity value, which we divide by the amount of shares outstanding for the implied price per share. Right, and whenever we're making these sorts of valuations, what we're doing is we're trying to get a value of the asset and then compare that to the cost of investing in that asset. Right, so in a situation like this, if the implied value per share is less than the cost of accessing that share, that means that the company is likely overvalued. If you have great trust in the model that you put together, that would mean avoid purchasing. Or if you're already holding on to it, might be a good time to sell. So we'll do a somewhat simplified example of putting together a cash flow table in a little bit here. So if you do have questions, I guess you can ask now, but we'll be putting this together ourselves in a little bit. All right. So just specifically the formula that we used in that terminal value and what it's going to look like is basically what we're seeing here, just translated into Excel. Right. So what we have in the numerator here is our next period's free cash flow. So that P88 reflects that last time period's free cash flow times 1 plus the growth rate to get the future period's cash flow divided by the growth adjusted discount rate. Right, and divide all that by our discount factor because this occurred 5 years into the future. All right, so we use cash flow to look at the value of an asset, but very often earnings are what are going to be focused on, and there are several reasons for this. First and foremost, it's easy, right? One thing that you'll consistently find is when people have to decide to do something, typically they'll err on whatever is easier. That's just kind of the human default mode of thinking. If you're looking at human decision making, if you try to think of the perspective of people are going to do what's easiest, that will tend to explain a lot of human behavior over time. It's no different in this field, right? Earnings are directly reported in the income statement. Companies have to report them already. So if you don't have to take any additional steps to look at a company's value, they'll just go ahead and look at what's already reported in the financial statement. Oftentimes, earnings are tied to executive compensation. Right? So because of that, management will often focus on earnings rather than cash flows because earnings are where their bread and butter are being tied to. Lastly, it's also related to cash flows. Right? We can use earnings as a starting point to get to a company's cash flow, but we know there are many additional steps we have to take. Right? We start with earnings. We have to adjust for cash changes, specifically depreciation, amortization, capital expenditures, change net working capital. So it's related to cash flows, directionally usually, but not quite the same thing. Lastly, it's a measure and a pretty good measure of a company's ability to cover its capital costs. Right? When a company takes on debt, they're going to be paying interest on that debt, and earnings are a good reflection on a company's ability to pay off that debt and cover their debt costs in a given time period. So very often, creditors will look at a company's earnings and ability to basically just pay off their debt in a timely manner. Right? When companies are, or when lenders are providing that capital, one of the most important considerations for them is, are they going to receive their money back? Right? They don't really care if a company is generating significant free cash flow. What they do care about is a company able to cover its capital costs. Right? So lenders aren't necessarily as concerned with free cash flow and the overall asset value so much as the company's ability to service debt. All right, so using earnings, companies will very often assign credit ratings, or public companies will have credit ratings. All right, so this is Standard & Poor's. There are several credit ratings agencies. They all unfortunately use different letters to reflect the credit worthiness of companies that they're covering, but it's still a similar ranking system. At the top, you have investment grade, AAA. Those are the companies that are most likely to pay off their debts and have the lowest probability of default. And then from there, you're looking at increasing probability of default all the way down to companies that are actively in default, meaning they're not paying off their debt. Right? So how do companies determine what the appropriate credit rating is? Basically, it's a mix of a lot of factors, but a lot of it is the company's ability to pay their interest expense and what do the company's cash flows look like relative to assets and earnings being generated. All right, and so basically what we see here is across the board, credit ratings decline across earnings. Right, so having sufficient earnings is going to also increase the company's earnings in the future because they're receiving capital at lower cost. Right, the spread in the interest rates between AAA and CCC can be quite drastic. So moving out of the junk bond area toward the investment grade can save companies significant amounts of money when they choose to raise capital. And I think with that, we're going to go, we've already covered. We're going to go over to Excel and start putting together a cash flow table to start working on value. All right, so we're going to start from scratch to look at putting together these tables. So a reminder, we have the free cash flow sheet. We're going to go ahead and use the depreciation tax shield method. Right, there's more information contained in this, but that's going to help us put together the cash flow table. All right, so copy over up into the information. Caps was on. All right. So this is going to be our cash flow information. We're also going to have growth tax rate and discount rate. All right, so we're going to get our baseline at time 0. Actually, to save us a little bit of time, we can just copy and paste this over. All right, so we're taking our depreciation tax shield cash flows. All right. Now remember, the value of an asset is based on future cash flows that an asset is expected to be generating. All right, so we're going to take the standard 5-year approach, and we're going to forecast the expected future cash flows of Walmart. All right, so we're starting with the revenue, cost of goods sold, selling, general, administrative, depreciation, capex, change in net working capital for the overall free cash flow. So there's a few ways that we can go about this. We can use the simple route, which is what we're going to end up doing just to save a little bit of time. That's basically just assuming that these values are going to grow at a fixed rate. Right? Then you have the asset productivity method, and that is more tying together the costs relative to the assets in place. Right? So does a company have to expand its assets significantly in order to fund future revenues? And we also have the percent of sales method, right? So as revenue increases, everything increases proportional to that revenue. All right, so let's go back to company's cash flow statement and see if we have enough information to at least get a growth rate over 2 years. Actually, no, we'll only be able to get 1-year growth rate. All right, just to save a little time, we'll look at the growth in net income, which I think ended up being negative. That complicates things one more time. All right, so they had significant average decline in net income. I saved cash flow growth rate over here as well. Oh, I forgot to save it into this table. So the average cash flow growth model I was using this in doesn't work unless I have the extension added, so I don't think this will load. Yeah, and it's not going to load up. I'm going to take a shortcut since I can't get this other model to load. I'm just going to take the cash flows calculated in there. So I cheesed it a little bit with the growth rate. I don't think I'll have the administrative requirements to get this extension on here. We'll just use this growth rate over the cash flow forecast period, and then we'll add in a terminal growth rate. All right, so we're going to use the simple method. So we'll just tie together all of these costs growing at this 7.5% growth rate. All right. So now we have our cash flows over this time. And we're going to go ahead and calculate the terminal value in this last year. All right, so why did I choose this growth rate of 2% rather than the 7.5% average cash flow over that time period? So the basic idea here is just take a second to think about a company growing in perpetuity. That means, did you have a question? Okay. That means a company is growing forever, right? So at 7.5%, that's basically saying that eventually Walmart is going to be larger than the overall US economy, which typically grows at an average of about 2%. Right, so generally speaking, when the company is growing in perpetuity, you want to have an upper boundary of the larger economic growth of the economy that the company operates in. Right, so if the US typically averages somewhere about 2% GDP growth, we don't want our company's growth rate to be larger than that, because that means that eventually this individual company will be larger than the whole economy that it operates in. Right, so typically we want that to be our upper level boundary. It's not uncommon to see terminal growth rates close to 0% because very often when companies age and mature, not only will they stop growing at the rate that we've observed, but it's also possible that they'll decline in size over time. That will see their cash flows shrink. Right? So another reasonable option is to have a low negative growth rate as the terminal growth rate. All right, so this terminal value is going to make up a large component of this company's overall value. Tax rate that we took out. All right, so following along with our formula now, right, we want in the numerator the next period's future cash flow. So to get that future cash flow, we take the free cash flow today, multiply it by 1 plus our terminal growth rate. Now we have our numerator. All right, and we'll divide this by our growth adjusted discount rate. So the WACC, I forgot to include that, so we'll have to get information for the WACC minus the growth rate. All right, so in order for this to be a sensible value, we have to go back and get information for the company's weighted average cost of capital. And there's a few places that we can get this information from. So this is one of the free resources that I highly recommend. Damodaran is a professor at NYU and collects and continually updates data on companies, particularly at the industry level. Right. So what we're going to be looking for here are discount rates that we can use for our company, cost of capital by industry, and we'll get US information. All right, so we're dealing with Walmart. That is going to be in retail. All right, so it gives us information on the company's cost of equity and the overall cost of capital. All right, 10.67%. Let's see what that FIQ model I used had a WACC of 8.6%, right? So that was likely coming from a lower cost of debt than we see over here. All right, so just to keep it simple, we can use the overall cost of capital that we're getting out of Damodaran, 10.67%. And that gets us the terminal value for the company. And like I mentioned, right, that terminal value usually makes up the majority of the value of a firm when you're looking at its overall value. And that's exactly what we see going on here. When we look at the future cash flows over this 5 years, that's about 27 billion, right? These are in millions. So the terminal value of the company is making up the majority of this firm's value. All right. So now we have to apply our discount rate to the rest of these cash flows, right? We're today times 0. We have our future cash flows. We're going to go ahead and take the value of these cash flows today, right? So we'll set up our discount factor. All right, so the discount factor is 1 divided by 1 plus our discount rate raised to the year. Should be equal to 1 today, right? There, no time has taken place between today and now. And now we're going to be getting our present value of our future cash flows. All right, so that's going to be, I'll add in our terminal value to the free cash flow in each year. Now we have an estimate of the company's overall value. If we want the value of equity specifically, we'll have to net out the company's debt. So that's going to be found in our balance sheet. So we'll add in our short-term borrowings plus our current portion of long-term debt plus long-term debt. We'll also net out the company's cash that they have available. Now the overall equity value of the firm is the total value minus debt, net of cash. Now we need the total per share amount, right? And we can get that on the company's tear sheet. So if you just look that up, one of the first free links available will get you that information. So it has, that's its total market cap. The change in shares. There we go. That's what I was looking for. And it's gone. Shares outstanding, 2.69 billion. All right. So let's double check our values. This should be in millions. All right, and that gets us our rough estimate on the value per share. All right, so significantly lower than the company's market value, outstanding. There's a couple of things going on here that we can look at that might result in significant changes. First and foremost, when we go from the standard bottom-up approach to the depreciation tax shield approach, the company's free cash flow declines significantly, right, by more than half. When we look at the baseline, right, when we look at the baseline cash flow used from right, the EBIT approach, the company's free cash flow was about 10 billion higher than what we had calculated here. All right, so depending on how you measure a company's free cash flow is going to have significant effects on the total value that you estimate for that company. All right, so depending on your assumptions, you can arrive at significantly different values from what you'll see other people arrive at, and also from what you'll see in the market. All right, so depending on how close you think your model is at reflecting the company's value, is going to reflect, right, well, what you should do with your decision making. Right, this was just a very brief cash flow table put together to value this company. Right, the WACC is likely lower than it is stated here. Right, and in that model, it was 8%, going from a 10.67 to something like an 8.5%, going to increase the value significantly. The model also assumed a higher growth rate. If we add in a higher growth rate, again, we're going to be getting a higher value. Right, so there are different steps that we can take to look at the overall value of the company and see what its true value is relative to the price per dollar in the open market. But again, these are all based on assumptions. Right, we need assumptions to put together any sort of valuation, and we just have to gauge how accurate do we think those assumptions are in this company's overall value. Right, another good example is the high tax rate that we've seen here. Right, if we drop it down to something, oh, it's no longer linked. That's why it's not going to be updating here. If we had a lower tax rate, then the company's overall value would increase significantly as well. Right, so there are a lot of inputs here that we have to deal with, and trying to make sense of those inputs is going to be reflected in how justified do we think we are in the bottom line. Right, so it's possible to find values that are significantly outside what the current prices are, and again, depending on what you choose for your model's assumptions, will result in those different changes. Right. Any questions on putting together the cash flow table? All right, so again, this is just tying together everything that we've already looked at. All right, we start with the free cash flow that we've already calculated. From there, we grow our expected cash flows over the assumed time period, right? In this case, we chose 5 years. At the end of that time period, we take the terminal value of those cash flows, meaning we expect those cash flows to occur in perpetuity. Then we put all that together with the rest of our cash flow table. We take our discount factor, multiply it by our expected future cash flows, add up all of those present values, and that gets us the value of the security today. Same general steps whenever you're valuing any type of asset. You set up your time periods, allocate your cash flows, discount your cash flows, and then add it all up for the final value. Same 4 steps every single time. Time periods, cash flows, discount, add it up. The inputs can get more complicated over time, right? With equity, we usually assume a 5-year time horizon for predicting the company's value. When you're dealing with something like debt, that debt contract will tell you how long that security is going to be outstanding. If you're looking at a 1-year treasury, it's 1 year. If you're dealing with a 30-year corporate bond, it's 30 years that you're going to be looking at that asset's cash flow. Right? So depending on what you are looking at is going to determine what the time period is. It's also going to determine what the cash flows applicable to the asset are. We're dealing with a company overall here, so we're looking at the company's free cash flows that it's generating. All right. Any questions on putting together the cash flow table? Yes. Uh-huh. So the problem is the amount of information you have. So the model that I started with has 5 years of data from which we can get 4 years of growth rates, right? You need at least 2 years to get one growth rate. So if you only have 3 years, you're only going to be able to get 1 to 2 growth rates, really, depending on how many years of balance sheets you have that you need to get cash flows, right? Because going one step further back, you need at least 2 years of balance sheets to get some information on the company's cost of capital and change in net working capital. So you're going to be a little bit more constrained on your project. You're not going to have that much information. So a couple of things you can do in place of that. MD&A often will discuss what they expect the company's growth rate is going to be. So you can look in there. You can look up analyst estimates on what the expected growth rate in the upcoming years is going to be. Very often you'll be able to find free reports on that information. So for the average growth rate, you can use those methods. If you have at least 3 years of data, yeah, you can just look at the growth rate there. But very often that's not enough information, right? Even over the 4 years that we looked at here, there's significant variations in growth, right? Negative 6% to positive 65% change in free cash flow. Negative 56% the next year, and then positive 28, right? So that's a significant amount of variation over 4 years. Well, you can't read that from back there, I realize now. But that's a significant amount of variation here, right? So if you can't get a growth rate from the information you have, great, you could do that. If not, then look to the management discussion, free analyst reports on the company. And if nothing else, then you can look at the company's income growth or operating cash flow growth, something like that. Sometimes people even use revenue growth if the company has had consistent negative free cash flow over time periods, which can occur. So there are different stages that you can kind of go through to try to find the growth rate. But again, right, typically 2%, 2 to 3% is a good upper boundary for terminal growth rates. Again, if it's higher than that, that's basically assuming that this company's going to grow to be larger than the economy it operates in. Right, so you usually want caps on your terminal growth rate. Any other questions? All right. So I know many of you have reached out to your project partners at this point. If you haven't already, please do so and respond to the people that are reaching out to you. If you're having any difficulty getting a response from a team member, let me know by email so I can reach out to them, confirm that they're still in the course, or if they're just not responding to you.